I guess I ask this question a lot. Kathy, how do you use gold to trade silver? It's one of the most valuable relationships in the entire metals market, and when you understand it, you can anticipate silver's next move before it even happens. Here's how we'll break it down. In this video, you'll learn how to, number 1, use gold as a leading indicator. Number 2, how to read the gold and silver ratio. Number 3, how to confirm with intermarket signals. Number 4, how to implement the trade. And number 5, how to manage silver's higher volatility. If this kind of content helps your trading, make sure to like, subscribe, and turn on the bell so I know to keep creating content like this. Let's start with tip number 1. Understanding the correlation between gold and silver. Gold and silver are both precious metals, and they tend to move in the same direction most of the time because they're influenced by the same factors: inflation expectations, US dollar strength or weakness, interest rates and what yields are doing, overall risk sentiment, whether investors are seeking safety or they're taking risk. But there's one major difference. Silver is the higher beta version of gold. That means it reacts more aggressively to the same macro forces, both upwards and downwards. That means when gold rises 1%, silver empirically will often rise 1.5% to 2%. When gold falls, silver tends to fall even faster. However, silver's industrial side cuts both ways. During bull runs, it helps silver outperform gold. But in bear markets and recessions, silver's industrial exposure becomes a liability, causing it to underperform gold. That's why professionals often use gold as a signal and silver as the trade. Gold provides direction, silver provides the acceleration. That's where tip number 2 comes in. Watch the gold and silver ratio. One of the best tools for trading these metals together is the gold and silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. The gold and silver ratio is basically the price of gold divided by the price of silver. This ratio helps traders determine when silver is cheap or expensive relative to gold. A high ratio above 85 means silver is undervalued, a potential buy opportunity. A low ratio below 70 means silver is expensive, time to be cautious or rotate back into gold or sell it. You can also use it directionally. When gold is rising and the ratio is falling, silver is leading, a bullish signal. When gold is rising but the ratio is rising too, silver is lagging, which is a weaker signal. You'll often see that when gold breaks higher and the ratio starts tightening, silver follows with strong momentum moves. Let's take a look at what this looks like on the charts. So let's take a look at how the gold and silver ratio can be used to trade silver. So I've got the gold and silver ratio here, and I'm going to add on my silver instrument over here. So the silver instrument is the blue line, and gold and silver ratio is the gold line. So we're just going to move this to another panel so that it's easier to look at, and then I'll show you where the trades are. So just give me 1 second, pin to the left, and we're just going to move this to regular. And so here you go. Now the blue line is silver. The gold ratio is gold. So I hope that's easier to understand. I had said that 85 is an extreme level, but these days it's gotten much higher. We see here that the gold and silver ratio spikes all the way to 104, but as soon as it goes above 90 and a huge spike, this means that silver is getting undervalued, and therefore you should be looking to buy silver. So you see the ratios spike, and so you should be using your technicals, probably when we have this double bottom over here, looking for opportunities to buy silver, which is the blue line. Because when the ratio spikes, it means that gold is rising really fast and silver is undervalued in comparison. Now, in contrast, when you have a sharp drop in the ratio, like over here, let's see if we can find the sharp drop in the ratio. When you have a sharp drop in the ratio, that means that silver is getting expensive relative to gold. So perhaps you should sell silver. So here we have the ratio getting very, very expensive. It drops sharply somewhere around here. So you should be looking for opportunities to sell silver. And if you did, you would have sold silver, somewhere over here, participated in this overall decline in silver. So that's how you can use the gold to silver ratio for trading. Tip number 3, use gold as the lead indicator. Gold sets the tone for the entire metals complex. It's more liquid, more widely traded, and responds first to macro catalysts like yields, inflation, and the dollar. Silver, by comparison, tends to react to gold's breakout or breakdown with a short delay. Here's how to use that relationship. Number 1, watch for gold to break a key resistance or support level. Number 2, confirm the direction with yield and the US dollar index. And number 3, once the gold's move is confirmed, look to enter silver in the same direction. For example, if gold breaks above 2,400 while treasury yields fall, that could be your green light. Silver might still be sitting at $28, but historically tends to catch up, rallying $30 even higher. You'll often see silver lag slightly, then accelerate rapidly once gold's breakout gains traction. reaction. This lag is what creates opportunity, and I'll show you what this looks like on the charts. Now we're going to look at how to use gold as a leading indicator to trade silver on breakouts. So the candlesticks here is gold and the line is silver. I might change the silver line later. But what we're going to do is let's pretend we're going to trade this on a intraday basis. So we're going to look at the 1 hour chart. We're going to look at the 1 hour chart and we're going to focus on the 4,000 level. 4,000 is certainly a really big number in gold. And we're going to look at the first time gold broke above 4,000, which is going to be at this point over here. So we got a big technical level, gold 4,000, and it breaks out to the upside. So gold's breaking out. Let's see what silver is doing. I'm going to change this to candlesticks as well, so that's easier to follow. So silver, as you can see here, gold is breaking out right over here. Silver, right down here, this is the exact same candle right over here. This candle is the same as this breakout candle here. And you can see gold is breaking out. Silver is just kind of trying to figure out what it wants to do. It's still consolidating. So if you see a confirmed breakout in gold like this, where we get a close above the previous high, close above 4,000, it's a sign that you see a continued bull run in gold. But minimally, even if you don't, it's a sign that we're getting an upside breakout, which if you bought silver here on the close, you would have had a nice trade to the upside, using gold as a leading indicator for silver around key levels. Tip number 4, intermarket confirmation. When trading silver, always confirm your bias across related markets. For a bullish setup, you want to see gold trending higher, the US dollar weakening, and treasury yields falling. For a bearish setup, you want to see gold trending lower, US dollar strengthening, and yields rising. If gold rallies on safe haven flows, if silver fails to follow, it often means that the market is still defensive. Investors are buying gold for safety, not for speculation. Silver tends to outperform only when risk appetite returns. With gold, yields, and the dollar align, that's when silver delivers its strongest trending moves. Tip number 5, trade implementation. Once your direction is clear, it's time to trade. You can trade silver futures on the COMEX through your broker or with a prop firm like Apex Trader Funding, the #1 futures prop firm that we recommend. You can also trade silver ETFs like SLV or silver spot CFDs with 8cap, our recommended CFD broker. And for those of you that are in the US who want to trade Forex and CFDs through a prop firm, check out Think Capital. And there's Axie Select, of course, for those of you outside the US who want a free funded trader program. Now, discounts for all these companies are in the description of the video below. Whatever vehicle you choose, use gold's technical levels to define your entries and exits. If gold breaks above its 200-day moving average, that's your confirmation for a potential long setup in silver. If gold falls below that level, it's a signal to reduce risk or exit. Always keep the gold-silver ratio on your watch list, as it's your early warning system for changes in market sentiment. Tip number 6, manage risk. Silver's volatility demands strict discipline. A $1 move in silver can equal the same notional impact as a $20 move in gold. That means smaller position size, wider stops, and structured profit targets. The goal is to capture silver's higher volatility without letting it turn against you. Now let's talk about the other side of the coin, the part most traders overlook, which are the dangers of trading silver. Silver can be incredibly profitable, but also incredibly unforgiving. Number 1, it can have extreme volatility. Silver can move 3 to 5% a day easily. That volatility creates opportunity, but also means that your stops need to breathe and your risk must be predefined. Number 2 is thinner liquidity. Silver's market depth is much thinner than gold, especially outside the US trading hours. Wider spreads, higher slippage, less predictable fills can make execution more challenging. Number 3, don't forget about its alter ego. Precious metals versus industrial metal. Half of its demand comes for industrial metal uses like solar panels, EVs, electronics. During expansions, this helps silver outperform gold, but during recessions, that industrial exposure becomes a liability, and silver can underperform sharply and sell off more aggressively while gold holds steady. Number 4, there's less central bank demand. Historically, central banks have been focused exclusively on gold. This is beginning to change, but with only some central banks, notably in Russia, Saudi Arabia, they started to add silver, but it's still a small share of the global reserves. But it may signal a long-term shift in how nations diversify their holdings. Number 5, beware of overnight and weekend gaps. Silver is more prone to gaps after major events such as inflation reports, Fed meetings, geopolitical shocks. If you hold positions overnight, make sure you size down or hedge your exposure. Silver rewards preparation, not luck. Let's talk about why many traders prefer gold over silver, because despite silver's explosive potential, most professional traders still anchor their strategies in gold because number 1, it's got more liquidity. It's one of the most liquid assets in the world with daily turnover with an excess of $200 billion. It also has tight spreads and consistent execution. Number 2, as predictable macro behavior, gold reacts cleanly to key variables like yields, inflation, and the dollar. That predictability makes it much easier to understand and build strategies around. Number 3, smoother volatility. Gold's moves are steadier, which allows for, tighter stop losses and better risk management, which is critical for traders, prop traders, any type of traders. Number 4, structural support from central banks. Gold rolled as a reserve currency creates a consistent bid. When volatility spikes, gold often finds institutional demand as well, which is something silver lacks. Number 5, technical clarity. Gold respects technical levels more consistently. Support and resistance zones hold better. False breakouts are less frequent than in silver. In short, gold gives you the stability, silver gives you the speed. So how do you use gold to trade silver? You start by understanding the correlation, you monitor the gold and silver ratio for relative value, you let gold's breakout or breakdown define your bias, you confirm your direction with dollar and yields, and then you trade silver with a smaller size and tighter risk management for an amplified move. Gold gives you the clarity, silver gives you the acceleration. Together, they form one of the most powerful intermarket strategies in trading these days. Gold is the signal and silver is the trade. I'm Kathy Lien with BKTraders. If you found this video helpful, don't forget to subscribe and turn on the notification bell. And don't forget to check out the description below for discount links to our favorite prop firms and brokers: Apex Trader Funding, ACAP, Think Capital, and Axie Select. Trade smart, stay disciplined, and I'll see you in the next video.